In last month's market commentary video, we discussed how to use index put warrants to hedge against further short-term downside in the markets. In this month's video, we shall find out how exactly put warrants tracking the Hang Seng Index in Chinese shares jumped between 93% to 196% as Chinese and Hong Kong stocks traded to its lowest in 13 years in the month of September. Hi, I'm Jamie from Macquarie Warrants, and I'm here to share with you some highlights of the market action last month and how you could have used warrants to capture some of these moves. If you have been following our monthly commentary videos, you will remember our coverage of how investors can consider using put warrants to hedge against short-term downside risks, given the flurry of negative news ranging from a hawkish Fed, global inflation worries, as well as lockdown news in China towards the end of August. Indeed, put warrants made stunning gains in the month of September. Some of the top-performing put warrants include those tracking Xiaomi and Geely, which are amongst the worst-performing index stocks on the Hang Seng Index. Particularly, put warrants over the Hang Seng Index more than doubled in prices after the Hang Seng Index finished as the worst performer amongst global equity benchmarks in September. Hard hit by a combination of the global sell-down due to aggressive Fed rate hikes, as well as slowing Chinese economic activity, the Hang Seng Index futures tumbled more than 2,000 points, or 11.2%, to trade just above the 17,000 level in just 3 weeks. Given the plunge in the Hang Seng, both Hang Seng Index call and put warrants made larger than usual moves during the month. The Hang Seng Index call warrant YV9W fell 84.9% during the period, nearly 8 times more than the Hang Seng Index futures, which was down 11.2%. Hang Seng put warrant OPTW, however, went up by 138.7% during the same period, providing magnified gains that would have helped investors wanting to hedge against the drop in the markets. Indeed, the magnified returns, or gearing, provided by warrants is one of the main reasons why investors would consider using warrants to trade short-term moves instead of directly using the underlying shares or index. How much more warrants move given a move in the underlying price in the short term depends on their respective effective gearing levels. To estimate how much you should be investing into warrants, you can also use effective gearing as a guide. As an example, if you were currently invested with $100,000 worth of Chinese shares and wished to hedge against a short-term downward move in the overall Chinese or Hong Kong market, you can either consider a put warrant over the specific stock, if available, or a put warrant over the Hang Seng Index. Looking at the previous example of Hang Seng put warrant OPTW, which moved 12 times more than the HSI, the put warrant had an effective gearing of 12 times. In this case, an investor who wished to hedge against a share portfolio of $100,000 would only need to invest around $8,400 into this put warrant, which is 12 times less than his or her share exposure. Looking into October, investors will be waiting to see if China's twice-a-decade Communist Party Congress in mid-October will boost the Chinese and Hong Kong stock markets, as it typically had in the past. Meanwhile, China continues to ramp up its support of the Chinese housing market ahead of this event. For further details on warrants and how to start trading them, log on to www.warrants.com.sg or feel free to contact us at our warrant hotline. Also, don't miss out on timely market news, as well as warrant investment ideas by scanning the QR codes in blue to join our Telegram channel. Looking forward to speaking to you again in next month's market commentary video.